Good deals aren't hiding from you. They're hiding from the way you're looking. You may think that you need a secret handshake, a family office last name, or a broker who likes you, but you're wrong. All you need is a system. If you're hunting for multifamily deals and coming up empty, then it's time to fix your system. And in the next 8 minutes, I'll show you exactly how to find good deals that investors will go crazy for and save you months of agony in the meantime. Let's dive in. You've got LoopNet, Zillow, Redfin, all open in a million tabs. You're scrolling until your eyes hurt, and every value-add deal is either priced into the stratosphere or labeled investor special. And when you actually underwrite it, it only works if some rehab fairy shows up and does the labor for free. So you plug in the numbers into your calculator, they don't pencil out. You finally see something sort of promising, but boom, it's already under contract. And that little voice starts creeping in. Okay, be honest, the real estate deals are for insider. Am I just late to the game? No. Most beginners hit that wall and they mentally check out. And technically, they are still looking, but emotionally, they're already decided that the whole game is rigged. So I want you to lock this in. Good deals aren't scarce. Good filters and good systems are. So instead of hyping you up with they're out there, just keep going nonsense, I want to actually walk you through why good deals feel so rare and what the people who do find them are doing differently, and how you can start sourcing deals that real investors will fight for, not just politely review. So let's zoom out for a second. In US, we're basically built this job cluster cartel. All the sexy industries, big tech, finance, consulting, pharma, media have poured in the same handful of matrix. Capital followed the jobs and the jobs followed each other. So you end up with this geography tax. The same 6 or so markets get a huge chunk of the high-paying jobs and venture dollars, and then everybody tries to buy real estate there. What does that do? It makes those markets insanely competitive and insanely expensive. Cap rates get compressed into 4 to 5% range. By the way, if you don't know what the cap rate is, watch my video about the multifamily terms you need to know. Anyway, everyone's fighting over the same 12 buildings like it's Black Friday at Best Buy. So when you say, why can't I find anything in LA, New York, or Miami, or Austin that makes sense? Well, the answer is because everyone and their cousin is trying to shop in the same aisle. Meanwhile, you have secondary and overlooked markets in the Midwest and parts of the Southeast, logistics and hospital towns, not just influencer cities, and they're quietly sitting there with 7 to 9% cap rates and a very real value add potential. But the problem is they're just not trending on TikTok. So no, you're not bad at finding deals. You're just shopping where the crowd is the thickest. Now, here's the big shift in thinking. Most beginners are browsers. Pros are sourcers. Browsers just sit and wait. They sit on public sites, refresh listings, and hope the algorithm just blesses them with a miracle. But pros, they assume the opposite. If it's easy for them to see, it's easy for everyone to see as well. So the best stuff either never hits those sites, or if it does, it's gone before the email blast even lands. Roughly 80% of the best multifamily deals never live their full life on public listing. They're either off market, whispered, traded within certain circles, small circles, or they move so fast they might as well have been. So if your current strategy is I'll just refresh Crexi and LoopNet and feel defeated, you've basically chosen to live off leftovers. Let's get you out of the tourist mode and into the operator mode. Before we even talk about calling anyone, you need to get clear on what a crazy good deal even is. Not in theory, but for you. Investors don't go crazy for cheap. They go crazy for clear. They want to understand what is this deal, where is it, what's broken, what's the plan, and what does the math say on the other side. So step 1 is building a buy box. Think of your buy box as a one-line description of the kind of deal that you hunt, not I'm open to anything. That's how you sound like a rookie. I mean, here is the type of properties I specialize in. Something like I'm looking for 10 to 30 unit Class B or Class C buildings in working class neighborhoods in Indianapolis with below market rents and at least 15% upside in NOI through renovation or better management. That's your buy box. It tells people where, what, and how you create value. And even if the numbers are rough in the beginning, you still need a lane. Investors cannot obsess over your deal if you can't explain what you're hunting for. And once you define that buy box, now we get into markets. Instead of somewhere in Texas or Florida, which is like saying I want something tall and nice, you are going to get specific. You want market with solid, not insane population growth. 2 to 3% annually is plenty. Job growth in multiple industries, not just one factory or one military base. You want vacancy in that healthy middle, roughly 5 to 8%. Low enough to show demand, but high enough that it's not so tight that you can't renovate or push rents. And you want tenants who aren't already paying the absolute ceiling in rent, because if they're already stretched to the max, your value add strategy is just a rent hike that they cannot handle. The mindset shift is this. Stop asking where is hot and start asking where is underpriced compared to what is becoming. That's where investors go crazy. Not for what's already famous, but for what's quietly being mispriced. So now let's talk about how deals actually find their way to you. Think of your deal flow like a pipeline with 3 big feeders. 3 streams that constantly bring you opportunities. That's brokers, direct to owner, and local insiders. Let's start with brokers, because that's where everybody goes first. And most people completely squander it. Here's what most beginners say on the phone. Hey, I'm looking for a good deal. Do you have anything? To a serious broker, that translates as, I have no plan and I'm going to waste your time. You want to sound like someone who knows exactly what they're doing. Buy box. So the conversation becomes, hey, I'm focused on units, Class B and C buildings in these 3 submarkets. I like underperforming management and below market rents. Light to moderate rehab, not full gut. I'm using agency debt or local bank financing, and I'm looking to close on the right deal in the next 90 days. What do you have that isn't blasted everywhere yet? You just told them you know your size, your class, your strategy, and your capital plan. And then you ask the magic question, what's not listed yet? Your goal is not to charm one broker and hope they adopt you. Your goal is to identify 5 to 10 multifamily focused brokers in your target market and stay on their radar. That means touching base with them regularly every 30 to 45 days, not spamming them, but giving feedback on deals, asking intelligent questions, letting them know when you've written an offer or closed something. You're training their brain so when they see a slightly hairy 12-unit building that's mismanaged but fixable, they will think, oh, this is exactly John's thing. That's stream 1. Stream 2 is the one that most people say they want to do, but then never actually do it. Direct to owner. This is where you stop waiting for someone to package deals to you and start going straight to the people who own the buildings that you want. You can use data tools or plain county records really to pull a list of properties in that 8 to 40 unit range that have been owned for, let's say, 10 years or more. You're looking for mom and pop owners, not institutional LLCs with 8 layers of corporate structure. Those are often the buildings with sloppy management, deferred maintenance, and no clear succession plan. Translation, pain and potential. Then yes, you are going to reach out. That means letters, calls, sometimes literally walking into the leasing office if you're local. You do not open with, hi, do you want to sell me your building? No. That's what every single wholesaler on earth is doing. Try this instead. Hey, my name is Anna. I own or I'm looking to buy small apartment building in this area. Your property at 123 Main Street caught my eye. If you ever think about selling or even want to talk up numbers before you go to the broker, I'd love to be on your shortlist. You're not high pressure. You're not promising a unrealistic 7-day cash close. You're positioning yourself as the calm, logical future buyer. And most people will ignore you. Some will say no, but every once in a while, someone will say, well, what would you pay? And that's your doorway that you've been trying to get to. And stream 3 is the one almost nobody uses on purpose, but every real operator benefits from: local insiders. Every market has people who quietly know where all the tired owners are. Your property managers, loan officers, insurance brokers, contractors, even code enforcement officers and city planners. These people hear things like, we're exhausted, this building is a headache, or the out-of-state owner hasn't been here for 5 years, or they've had 3 fires and a break-in and they're done. Your line with them is simple. If you ever hear about a small apartment owner who's tired and wants a clean, fair exit, I'm your buyer. Call me first. And then, critically, very important, you actually follow through. If someone does send you a lead and it turns into a deal, you pay a legal referral fee or a big thank you. You're not just networking, you are rewarding behavior. And that's what makes people remember you. Once these 3 streams are flowing in and you're going to start seeing deals, some will be obvious no's, some will be maybes, and occasionally one will make you sit up straight. You need a simple mental filter so you don't spend 6 hours on every single listing that comes in. In the first 5 minutes, you're asking yourself, is the price per door insane compared to renovated comps in the area? Are current rents clearly below market with 10 to 20% upside if, let's say, you clean up the units and fix the management? And if I bring rents to market and run normal expenses, does the projected income cover the debt with a buffer? And is there a real fixable reason this property is underperforming? Bad management, outdated units, zero marketing, rather than something you can't fix, like a property that's sitting in a war zone with 3 structural issues and environmental problems. If it passes this sniffs test, then yes, you sit down, you build a real underwriting model and stress test it. But that quick filter keeps you from drowning. Your superpower isn't finding perfect buildings, it's finding fixable problems with mathematical upside. Now, let's talk about the second half of this. How to make sure these aren't just good deals to you, but deals investors go crazy for. Investors don't get obsessed because of the granite countertops. They get obsessed because of 3 things: the story, the numbers, and the operator. First, they want a clear before and after story. Right now, this thing is a 60% occupied and mismanaged. Over the next 24 months, we stabilize it to 95% occupancy. We bring rents to market, clean up expenses, and transform the NOI. If they can play this movie in their head, you're halfway there. Second, they need to believe the numbers. That means your rent comps are real properties nearby, your expenses aren't some fantasy land, and your exit assumptions are conservative. You're not selling a dream, you're presenting a real actionable plan. And third, they're betting on you. Here's what happens in the first 90 days. Here's the property manager. Here's what we are doing with the leases, with renovations, with delinquency, etc. They're not just investing in the building. They're investing in your system and your ability to execute. And that's the line you want to live in. I'm not asking you to fall in love with this one address. I'm showing you a repeatable system for turning underperforming buildings into cash flowing ones. And this is just one example of it in action. That's when investors start chasing you instead of you chasing them. So let's make this a very real and very simple, so this doesn't just become some great video that you watched and you went back to scrolling. If you dedicate your weeks to this, your life will look very different in 6 to 12 months. Okay? Define your buy box in just one sentence. Reach out to at least 10 human beings every week, either it's brokers, owners, or insiders. 5 deals, do quick filters, fully underwrite 1 or 2. You do not need 100 good deals. You need just one great one to change your trajectory forever. Most people quit right before they would have found it. They take 10 no's personally and assume it's a sign from the universe. It isn't. It's just math. So if you've been scrolling listings thinking, maybe I'm not cut out for this, maybe all this good stuff is taken, hear this clearly. You're not bad at this. You're just early. The problem isn't that insiders stole older deals. The problem is that most people never stay in the game just long enough to build a clear lane, a focused market, a real pipeline, and a reputation. Good deals don't belong to insiders. They belong to people who know exactly what they're hunting for, the people who show up consistently and make it easy for tired owners, busy brokers, and cautious investors to say yes. So when this ends, don't open another tab and go back to your passive browsing. Pick your market, write your buy box, make your first 10 touches in the next 48 hours. The market doesn't care how long you've been watching. It only starts paying you when you start sourcing. So start pricing like a tourist and start operating like the person that investors will go crazy to work with. And in this next video, I explain how to find a JV partner for a 6 to 20 unit asset. I will see you there.